When someone invests in the share market, he does it with the aim of earning a good return. When people buy shares cheaply and sell them at higher prices, then they have capital gains. Besides that, companies that perform well also give dividends to shareholders. Companies give dividends because they consider shareholders an important aspect of their business. However, it's not necessary to give dividends, but profitable companies generally give it.
Now let us see how we can gain that benefit through mutual funds. Okay, let us understand this. In fact, if investors want protection against the risk of lower return, they invest in dividend-paying funds that give a portion of their earnings as dividends. Let us first understand what dividend yield funds are. As per market regulator SEBI, any dividend yield fund scheme should allocate at least 65% of its investment in dividend yielding stocks. While buying or selling a share, investors keep in mind that whether the company is giving a dividend or not. They look for companies that have enough cash, strong financials, and regularly give dividends. So mostly dividend yield funds also invest in such shares that have high dividend yield or payout ratio.
Dividend yield is the ratio of dividend payout and the current share price. For example, the share price of a company is 500 rupees and it is giving a dividend of 10 rupees. Then its dividend yield will be 2%. Similarly, the ratio of dividend payment per share and earnings per share is dividend payout ratio. Dividend yield funds help investors in diversifying their investments and participate in different segments of the market. As per the 7th July 2022 data of Value Research, dividend yield mutual funds have given a 16% return in the last 3 years.
Now we will tell you who should invest in such funds. So as per experts, if an investor wants regular income but is fine with a lower level of earning, then he can invest in these funds. CFP and Investography founder Shweta Jain says, dividend yield funds are funds that invest in stocks that give high dividends. These are suitable for investors who are not very aggressive, as these are usually stable companies. Investors must remember that these are still equity funds, and while they may not be as volatile as thematic funds, they are still prone to ups and downs of the market. This could be a good option for investors who want to take the risk for higher returns but also want some periodic cash flow.